let's dive in. Jackson kind of set the stage a little bit. We're going to talk mostly, I think the meat of it is going to be in that February, in those February numbers. But we're going to look at some other data, other little data points that are going to help us kind of piece the puzzle together of what's happening out there. With that, all right, most of you know I like to start on a note of levity or two. I saw this one, not in person. I don't live near palm trees, but I caught this on the internet the other week. So this is the landscaping company, Ground Control, and then the HVAC company, Major Tom's. So Ground Control to Major Tom. Anyway, I thought that was interesting. So here's another interesting one, you guys, and this is a little bit outside the box, and it may not be an ideal time to be talking about warplanes, but let me just set the stage. Let me just give this example anyway. So these are sort of bullet holes from Allied forces, World War II planes, right? And these are the ones that came back to base, and they noticed that there was a lot of bullet holes, in these areas where you see these red dots. And so they kind of went back and thought about it, and there was, a couple said, well, why don't we just beef up and add some plating and some armor to where our planes are getting hit? And there was a Columbia researcher who actually said, now, wait a second, isn't it possible that the planes that get hit elsewhere don't return, right? So the planes that are shot in the engine, landing gear and flaps, and the fuselage don't return to base. So we can't collect the data. So what we should really be doing is beefing up and galvanizing the places where there aren't damage, right? Where we don't see damage. So, two people can look at the same data and see things two very different ways. And it's possible we're going to see a couple of charts where you can interpret it some different ways. So, we're here to show you kind of the what, and maybe a little bit of the why, but we're not here to tell you how to interpret and how to convey all of that to your buyers and sellers. So some of that, of course, falls on you guys. I thought this one was just fascinating. Yeah, I thought that was just fascinating. So this is where you really need to galvanize the planes. So I don't always need to know the value of my home, but when I do, I consult with a walking, talking, warm-blooded real estate professional in my area instead of a computer algorithm which cannot possibly identify and isolate all the many unique variables of my home for comparable purposes. All right, enough with the jokes, guys. Let's get serious. So as we do, so I checked participants a little while ago. I thought I saw a couple new folks and a couple returning folks. So we do some leading indicators. So we're going to look at some weekly data, specifically showing activity broken down by price point and broken out by year. And again, like I said, this is a leading indicator. It's the thing before the thing before the thing, right? Before you close, you sign a contract. Before you sign a contract, the listing has to be active, right? I have to be pre-qualified usually, and I have to usually go to a showing, not always. So if you want to know what's going to happen, if you want to know what's going to happen Saturday with closings, look at Friday pendings, right? Which is really Thursday showings. Of course, it doesn't work that quickly, but you guys get the idea. This is a leading indicator. So, I won't spend too much time on it, but 2022 here in our darkest color, looking okay, right? Looking okay. You can see 21 last year, kind of surging above the prior years at this time, but then fell below 2020 levels, sort of on the back half of the year, or at least most of the back half. So nothing alarming here in terms of showings. Decent numbers, kind of on pace, somewhere between, I guess, 2019 and 2020 and 2021. So again, something that we're tracking. This is through just the other day, just through Sunday, I believe. And so you guys can kind of get a sense for what's happening with showings. Of course, all price points are different. And so we break things down under 200K all the way up to our luxury segment, million plus. Don't mean to sound like a broken record. We update these, we update these weekly, but we show you guys the latest ones every month. So it's been a really similar trend, right? We've seen erosion in showing activity, a decline in showing activity for every price range under 300, right? So the more recent week in gray is lower than the year ago period in blue. We can see that happening, a loss of market share. And then we see gains in every segment over 300K and every price point over 300,000. So this was the share, but what about the change? So the share and the number can be very different things. And so don't read too much into that, but just know that we're showing a pretty similar story, that change in showings, declines in showings. Actually here, this actually shows basically anywhere under 500K. But as you get over 500, okay, still some negative numbers, but down 3 or 7%, isn't huge compared to 20 to 40% declines. And of course, guys, this is supply driven. It's if you don't have the product out there to show, then you don't have the product out there to write an offer on, and so on and so forth. So just how tight the market has become has really started to impact these numbers, as we've been seeing. Pending sales. So I won't do the new listing. I won't do the new listing chart, but I do just want, again, any newcomers to the webinar today, I want to just show you guys just how much the last few years have skewed a little bit and have looking at sort of seasonality. So typically we see sales activity, kind of reach its peak in, May or June, right? That's pretty typical. In 2020, right, with COVID, look at how much COVID flattened out that seasonal curve. And so the 2020 market actually hit its peak sales numbers, end of August, beginning of September. That's pretty rare, right? That's pretty rare. And of course, that meant that comparisons here were very different than comparisons year over year here, right? So sometimes, it makes sense to look at what happened in the year ago period versus the current year. And just like the plane, sometimes it's useful to look at what's missing instead of what's here. So 2022 with pendings, kind of right in the middle, guys, nothing all that worrisome, kind of matching up pretty closely with 2018. Changes in new listings. So this is change in seller activity, and this is 2-year change, right? So last month compared to Feb of 2020. So remember, this is pre-COVID, not by about a month, but this is pre-COVID. So here we see pretty significant surge in million-plus new listings over a 2-year period. See some solid gains in 500,000 up to 1 million, decent little gain in 350 up to 500, followed by losses in listing activity in every range under 350. So every range under 350, less seller activity, and that's existing as well as builders, right? As well as new. Hard to reach that price point on new construction, just given what's happened with labor and materials and everything. So change in pending. So similar story, 2-year change. We see the growth in luxury, you guys. That's where we see the growth. We see the growth in luxury. Change in new listings. So this is year over year. So this is all of 21 versus all of 20. A little bit more data, and therefore more reliable data. And so, I think I've said it before. I love how beautiful. It's a just perfect little sine curve. You cannot make this stuff up. So I was quite pleased with how that played out. Anywho, you guys can see our sort of transition space there. Again, it's at that 350 mark. That's sort of an important marker for our market. Yeah, I like that. So overall, new listings down about 1%. However, they were up 25% nearly for 500,000 up to 3/4. Down 30% for 150 up to about 200. Closings, so that was change in new listings. This is just change in closings year over year from 21 compared to 2020. We saw all those sellers over 1 million. I mean, are they going to flood the market? Well, we saw a corresponding surge in demand in that luxury segment, in that high-flying luxury market. Here again, basically everything over 350. Well, definitely everything over 350. Are the segments that are seeing gains, although one of your more competitive segments over 350, the most affordable segment over 350, about half the gain in sales than the other segments, some of these luxury segments. Maybe you call 550 affordable luxury, right? Entry-level luxury, I don't know. I'm sure you guys have names for these things. So let's just co-plot these really quick. I like to use that word. We're going to co-plot them. So pending sales, change in pending sales in blue versus change in new listings in gray. You guys can see demand growing faster than supply, here again in every range over 350. We just saw that. Yes, you're right. We just saw that. But, maybe useful to just have it on the same chart. By the way, guys, if you want to send these to buyers and sellers or sit down with them at an open or a listing presentation, you will have this in your hands. So that was 2-year change, guys. So that was 2-year change. Look at year-over-year change, a little bit of a different story. Here we actually do see new listing growth actually matching sales growth in this 500,000 up to 3/4 segment. And we actually see new listing growth with a contraction in demand for 750 up to $1 million. And then we see this 17% increase in seller activity, but a slightly lesser 11% increase in buyer activity over $1 million. Right, so different stories if you do year-over-year versus 2-year change, different stories as we talked about. All right, when it comes to data analysis, you excel. You're welcome. So we've looked at this one a few times. I won't spend a ton of time on it, but again, just for some of the newcomers, new listings back to 1967. I love the historical data just to kind of put the present market in context. So new listings in blue, and then buyer activity, closed sales in red. 2 things stick out to me, and those are bubbles. One is one you're probably, the first bubble is a bubble you're probably pretty familiar with, the 07, 08 Great Recession and mortgage and foreclosure crisis. That's that one. And then I know there's some folks out there who do remember this one, but maybe fewer of them out there in webinar land who might recall this one. But this was also a supply-driven bubble, and that ended with the recession of 91, 91, 92, maybe 90 to 91. I'll have to double check that. So, guys, bubbles are supply-driven, right? Bubbles are supply-driven, and bubbles start to pop and melt down when the demand isn't there to absorb all that excess supply. That's when we get into trouble. That's what happened here. That's what happened here. What do you notice about nowadays, right? Last year, never have we seen buyer and seller activity so close, so tight, right? Never since 1967. Looks like there was maybe a couple periods where we were close, but not quite there. And so let me just do the ratio of sales to new listings. So sure enough, for every 100 new listings, we had about 88 closed sales last year. Right, so that's a roughly 88% sales to new listing ratio. A couple other times it's been pretty high. Remember the dot-com bubble, kind of that hot market heading into 2001. And then there again, late 70s there with a 63%. But there's been a couple times it's actually been under 30%, 38%. So 87, 8, never have buyer and seller activity been this close since 1967. And likely before, likely well before. I only have those 3-ring. You guys remember those 3-ring binder mailers from North Star? Back when people printed things and used binders and things. I had to mine through some of those going back to the 1960s. But I think we can only go back to about 67. Anywho, okay, December new listing. So I want to just throw out a December, you guys. So we have not had December of 22. So we're only going to go through December of 21. I just want to show we did see this increase, followed by a little bit of a normalization, kind of getting back on this track. So this one sort of stands out. It's not that it wasn't real, it was real, it happened, but it wasn't really indicative of a turnaround in supply or it wasn't indicative of an increase in supply, an increase in new listing, in seller activity. We didn't see it. So February new listing, so here, down 6%, down 6.5%. Well below, 06, 07 levels. I wish I had better news for you guys. I really wish I had better news to share. This is the fewest number of new listings for, or I should say the second lowest number of new listings for any February going all the way back to 03, right? 4461. I suppose by what, 64 listings, we have outpaced February of 2019. Yay. Awesome. This figure needs to be higher if we want to continue to sell the volume of homes that we have been. And so that's going to be tricky. And remember, in a rising rate environment, how many sellers, well, excuse me, how many owners could be sellers are married to their interest rate, right? We are married in holy matrimony to 3%, and we want nothing to do with 4.3, right? So a couple things to think about there. All right, Feb pendings down 10 1/3%. Nice to see, I suppose, we're still above 2019 levels. Although again, Feb 2020 was sort of pre-COVID, so that wouldn't be a COVID mark. 05 bubble, February pending sales more than doubled. I can say with certainty, not all of those closed. Not all of those closed. Okay, so closed sales. So we did tumble about 14%, but look, you guys, that's after 2 years of pretty significant gains. Again, Feb 20, not quite a COVID year, or not quite a COVID month, but the following months clearly were. 2804, okay, so we're pretty closely matched up with 2019. Kind of wish we were a little bit higher, but we're gonna need inventory to cooperate. Let me also say, guys, we've had a couple years where we did lose, a little bit of sales activity, and that didn't, push us off our trend. Now this number, 14% is a bigger number than, well, it's not that much bigger than 12%, but it is bigger than 4%. I'll take things that are already known for 800, Alex. So this 2800, it's nice that it's well matched up, but obviously, if we want to keep sustaining these numbers, we need the inventory there. And it's not there. So February cumulative days on market. I sometimes joke, if you're on the market for 10 days and then you're off for 10 days, but then you're back on for another 10 days, you're really on the market for 20, not 30, right? Because you were off for those 10 days for a coat of paint or whatever, but you were on a total of 20. Now there's PDOM, price DOM, right? Days on market at that price point. And then there's just simple DOM, the days on market for that listing period, but cumulative kind of goes back and catches that previous listing. So we're answering the question, how long do I really need to be on the market in order to get an offer that I'm comfortable with, that I accept? Making cents of the dollars or dollars of the cents, whichever it is nowadays. Saw an 8.3% gain to 340,000. That's about where we ended last year. Haven't quite seen that seasonal uptick, although we are starting to in the weekly numbers. We haven't quite seen that trickle through the rest of our data, but as we get to March and April, obviously, we'll start to see that seasonal increase. 11.5% last Feb, right? That was that was partly a COVID signature there. And so, we've come down a little bit from that 11%, but 8% is still 8 1/3%, still relatively rapid price growth. Speaking of rapid price growth, I don't always like to show a table of numbers, but when I do, right, I have a couple percent changes to point out. So price growth appears to have peaked, about 9 months ago, in May of last year, where prices rose 16.5% from 295 to about 345, right? No big deal. Throw 50 grand, no big deal. And so, that was 16.5%. You can see acceleration into that 16.5. But here's what's important. We also see deceleration after that 16.5%, meaning we're still positive, prices are still growing, still at a pretty decent clip, but they're decelerating. So we're off the gas, right? We're kind of off the gas. We're not on the brake, but we're off the gas. And so, our car is still moving forward at 60, 65 miles an hour, but no longer the 70, 75 that we were. I know none of you drive 80. So 16, 15, 12, 11, 10, 8, I guess 10, 8, 10, 8. So, a couple months of roughly, 8%, about half that growth rate. But 8% is still a pretty strong rate of growth, rate of price growth. You can't make this up. Speaking of rates of price growth, so going all the way back to 04, you guys, looking at positive change, price losses, a little bit of stabilization around the tax credit period, followed by, we had to kind of finish finding the floor, finding our bottom, our footing. And then when we did, we saw a lot of these investors, some flippers come in, and not demonizing anybody, but we saw a lot of competition, a lot of demand sort of entering the market then as we embarked on recovery. And then we sort of matured into phase 2 of recovery, phase 2 and 3 maybe, which was what, 5 to 7, 4 to 6, 5 to 7%. And then enter COVID, and we see this COVID signature, right? So interesting. So look at, well, we won't totally geek out on the individual bars, but slight pullback, so let's see, April, May, June, January, February, March, April. So it looks like May was that pullback. And then by June, July, right? July, we got over 10%. And you can see we pretty much stayed there for quite some time. You can see over the last few months, again, prices still growing faster than they have been, not quite here, but, still kind of here. But not here or here, but you can see how things have moderated a little bit from some of these levels. So that is showing up in our data a little bit. February, percent of original list price received at the point of sale, at the time of sale. So good old days, 04, 05, sellers only got 98.3%, right? Heading into the crash, enter 2011. So that's where if I offer you 12% under your list price, I have a pretty decent shot of getting the home, of getting the keys. Good news if you're a buyer. If you were a seller back here, it was tough times, right? It was tough times. You basically had to give a 12% coupon, a 12% discount to buyers. Where do we stand today? 100.7. So that's over 100%. Same with last February, although not by much. You guys can kind of see we were plateauing a little bit at 98%. There's some history for that, right? There's some historical justification for that. And then, yeah, I mean, so yeah, Feb 21 was obviously a COVID month, Feb 20, not quite. And so then you see just, I mean, the pandemic absolutely shoved this metric over 100%, and it's stayed there for some time. It's really quite impressive. Speaking of quite impressive when it comes to this metric, let's just rewind a little bit to June of 21, 104.25, 104.2% of original list price received. Sellers were getting 100% of list price plus 4.2% for good measure. And look, guys, we had, we actually had two consecutive Februaries, right? 2 years of a softening in this metric of declines. So, there was something happening here. We know what it is. Our inventory, active listings, homes for sale, all synonyms, synonymous, all synonymous. So February inventory, in the good old days of 08, we had 31,500. Some of that was foreclosure and short sale. And then last month, we had a plentiful 4,000. 4,000 active listings. That's fine. That's totally fine. No, it's not. This is a challenge, you guys. This really highlights the supply crisis. There's not really another way to put it. Our supply crisis, which has, of course, in part caused an affordability, affordability challenges. So again, I wish I had better news to share with you guys here, but I do not. So let me back up for one sec, you guys. Why might we have some challenges here? Let's back up and think about this for just a second. In a market where homes are selling in 7, 10, 11, whatever, 15 days, let's call it 10. If you're on the market on Feb 10 and then you're off on Feb 20th, so you were listed on the 10th, you had an accepted offer on the 20th, we take a snapshot of inventory at month end, right? If you weren't active at the end of the month, we don't count you as inventory. But that listing that came on Feb 10th and went off on Feb 20th was technically active for, 10 out of 28 days. So it was active for a third of the month. It was an active listing. And so, should that be captured? There's arguments for and against that. How about, so how about Feb 2nd to Feb 27th? So you were active pretty much the whole month, but you're not active on the last day of the month. So you're not going to show up in the stats. How about if you came on Feb 20th and went off market on Feb 21, right? Sure, I guess you were an active listing for, a matter of hours. But, do we truly call that part of inventory at month end? I don't know, that wouldn't be captured. But these are debates to be had, you guys. These are conversations to be had. And Jackson and I have been kind of playing around with some revisions to our inventory methodology that would allow us to better capture kind of what's happening now, given the fast pace that we've seen. Month supply of inventory, 0.8 months. Again, plenty? No, that's false. So we're looking for 4 to 5, 4 to 6 months. We have 3 weeks of supply. Remember, 0.76 will round up to 0.8. So we probably have about 3 weeks of supply, and we're looking for 4 or 5 months. Let me do a little bit of backwards math for us. Let's not do the 0.8. That's a messy number. Let's say we're still at 1 month of supply. Okay, 1 month of supply, but we belong at 5 to be in equilibrium or to be a balanced market. Okay, to go from 1 to 5, we have to multiply by 5. You got it. So to get to a balanced market, we have to multiply our absorption rate by 5, which means we'd have to multiply our inventory count by 5, right? Which puts us, you got it again, puts us at about 20,000. So, that means we would belong kind of, just about here. We would belong just about here. So, right, remember, we had some oversupply issues. We looked at that. We talked about that. So, I don't know that we should shoot for 30,000. I don't know even if we were, if that would be a possibility in a reasonable timeline. So, it just goes to show just how short we're falling on the inventory side of things, especially at the first-time buyer price points. Let's see, Bill had a quick question. Do new listings show up or not the same way as actives when they miss? So new listings, if you were listed on Feb 27th, doesn't matter if you go off on Feb 27th or if you're still active today. If you were listed during that month, that's a new listing for that month, regardless of whether you're still active the next month, whether you're under contract, whatever. So we'll count that as a new listing. Yes, good question. Mary, new construction doesn't always show up. That's accurate, Mary. Unfortunately, we are not able to force builders to enter their listings. However, we really do encourage them, and we hope you guys encourage them to at least enter them as comp sold so that everybody can benefit from the data, to have the data, to use it as a comp, to justify or not, current price trends, current market dynamics. So no, we did do some analysis, and I think we showed but this was like 5 years ago now, so it may have changed. 5, 6 years, this is 2015 or 16 maybe. I think we showed that we had about 80% coverage. I think it was like 78 or 80% coverage of the new construction market. So no, it's not everything, but it is the vast majority. I'd like 97 or 98%, but I guess I'll take 79 or 80%-ish. All that is a way to say, you guys, we've got a representative sample, but we don't have a complete or exhaustive sampling. So Mary, it's a great point. We can still report on new construction. We just have to understand that we don't have 100% of the data, but we do have enough of the data to make some conclusions and to spot trends and any changes that we might see happening. So good questions, guys. Keep them rolling. Understanding month supply, i.e. an absorption rate, right? Same thing. Sellers markets. I've only got one listing, limited supply, but look at all these buyers amped up. They're ready. They're ready to write offers, right? But a buyer's market, well, so these buyers have to compete with one another. They have to outbid one another if they want to win over this house, right? So that's a seller's markets. Buyer's markets, you've got a lot of supply relative to demand. So you may be a little bit oversupplied relative to demand. So here, the buyers don't have to necessarily outbid one another. Here, the sellers have to outconcede one another, right? And outseller pays one another. So they have to offer concessions, right? Reductions, seller pays, right? Warranties, whatever. How about some fixes based on the inspection wish list? That kind of thing. That happens more in buyer's markets, obviously, than in seller's markets. Oh, Lordy, all we want is a balanced market between, 4 to 6, 5 to 6 months. That has proven elusive. Okay, this one's a little wonky, but I want to talk about it. So this shows price change here. So look, 0%. So minus 1%, these are losing price. Plus 1%, these are gaining price. Okay. So this axis is sort of price, but then this axis is absorption rate. Anything above here, right, has under 6 months of supply, and then below has over 6 months of supply. So what is this telling us? Let's break things down a little bit. There are no markets, nationally since 1999, there has not been a time where the market has been undersupplied with fewer than 6 months of supply where prices have also fallen. There's not a data point on record going back to 99. Now, didn't we just see we have 0.8 months of supply? So let's see, that's somewhere, well, if this is 1 month, 0.8 months is kind of somewhere here. That's a pretty powerful stat to me. That's a pretty powerful data point. So undersupplied markets very seldom see falling prices. Let me take a step back, guys. That's national. That's not to say there aren't some local markets where that has happened. We know that there are, but they're pretty rare. Where do you see most of the concentration? The clustering is in undersupplied markets with rising prices, right? There are plenty of oversupplied markets with falling prices, right? You've got an oversupply issue. Macy's has just too many suits on the rack. You got to take some of the suits and put them in clearance and cut the price in half, and then you'll move the items, right? You have an oversupply, right? Prices have to come down to clear the market of that excess, of that glut, to bring things back into balance, back into equilibrium, stasis, if you will. There's a word I haven't used in a while. And then, finally, oversupplied markets with rising prices. This does happen, right? Here's a market with what, call it 9.5 months of supply, where prices were still growing, still rising. So we see some stragglers here. We see nothing here. We see most of the activity, most of the concentration here, tight markets where prices are on the rise. And then we do see some oversupplied markets with falling prices. I told you that was wonky. I hope you guys kind of stuck with me on that, because what a powerful stat to say to buyers who are worried about prices cratering on them, until we hit 4, 5, 6 months of supply. There's a pretty low likelihood of that happening. Now, exogenous shocks to the system, suddenly, rising rates, pandemics, rising rates and inflation are pretty closely related, but there's a lot of new things happening today. So, while we like to say that past trends are indicative, they're not always perfectly reflective. History doesn't always repeat itself, but it usually rhymes. Okay, days on market going back to July of last year, 7 days on market. Yep, that's a week. Median, meaning half the listings went under contract in under 7 days, less than a week. Pretty crazy. All right, I said that right there. So speaking of pretty crazy, just how crazy is this market, and is it changing? So we looked at what percent of list price are sellers receiving, right? And what was it? 100.7. It's been 101.2, 102.1. Last year it was 104 at a point. But here we're asking how many sales are selling for over 100% of list price. Not of those ones that are, how much are they, which is 0.7%, but has been 2% and as much as 4%. This asks and answers the question, for every 100 sales, how many are over list price? And that's about 80, right? And you guys can see here again, kind of plateauing at about 60%, well above bubble levels of not even 50%, right? Kind of 40 to 50%. You know, when the market was kind of struggling, when we were down in the doldrums a little bit in our valley here, you know, still 1 in 5, right? Roughly 1 in 5 selling for over asking price. Different than 4 in 5. This is 4 out of 5 versus 1 out of 5. So pretty interesting. I like to point out, I love seeing the impacts of policy changes in the data. And you guys remember that tax credit, that 09 into 2010 tax credit? Look at how that spurred competition. But again, did it lead to a widespread market turnaround? Not really, right? It was just kind of a little pie in the sky while we were in our valley. All right, let's do some price reduction analysis. I think this is incredibly powerful. I hope you guys do too. I think you will. So what percent of our sales required a price reduction before closing, before selling? 1 in 5, right? Last year, 20%, 1 in 5. Between the years of 08 and 2011, it was more like 1 in 2, right? 5 out of 10, just about 50%. So you'll notice 20%, that's a pretty sharp decline. You know, we haven't had quite that sharp of decline, I guess, since then. You'll also notice, you know, we are below bubble levels, right? 03, 04, you know, we are well below that. Let me add something. Let me add something important. Guys, a lot of people didn't even know there was a bubble until 2020 hindsight, right? You know, don't get mad at me and don't throw virtual tomatoes, but you know, I only got here in 2010, so don't blame me. But you know, back in 03, you know, if we could see some of these increases in the prevalence of price reductions, it could have been a better indication that things are shifting, that things are changing a little bit, and it could have given us a little bit of a window and a little bit more lead time into, you know, kind of what happened here with the Great Recession and the mortgage and foreclosure crisis. Okay, so that's annually, right? That's annually. Let's look at monthly. Let's look at August. This is August of every year back to 03. Last year, only 17%. That's a decline. August, let's go to October. October, I register a little bit of an increase. I don't know why, what happened to September, you guys? What happened to my September chart? I guess I lost it. I do know that September did not show an increase. So October did show an increase, right? So guys, I know I'm bouncing around, forgive me. So August of 2020 into August of 21, we saw a decrease in price reductions. October of 20 compared to October of 21, we saw an increase in the share of price reductions and the prevalence of price reductions. Fast forward to November, we see an increase as well. And you'll also notice as we get into our winter months, of course, the numbers are higher, right? So August 17, October 23, November 26, and now let's watch December, right? 28, also an increase. How about January? Still about 28, but an increase. And then February, and I'm showing a decrease. So, you know, let's go back, you guys. I was pretty comfortable saying that this was becoming a pattern. I think I've said this every month for the last at least 3 months. Once is random, twice is coincidental, but 3 times is becoming a pattern. 3, 4 times is starting to become a little bit like a pattern here. And so, yeah, you know, seeing this increase in October, seeing that same thing in November, again in December, and again in January, I got to admit, I was starting to feel convinced that that was indicative of the beginning of a shift, of the beginning of a change. Not the beginning of some downturn or a crisis, but the beginning of a rebalancing where we go from 0.8 months, maybe to 1.5 months or 2 months, right? Still a strong market, but maybe a little bit more balanced. And, you know, again, I gotta follow my own rule. I gotta follow my own rule of, you know, 1 month does not a trend make, young Skywalker. And so, you know, again, this could be random. And then if we see it in March, that could be a coincidence, but come April, May, and June, you know, we're going to be watching this. And if we don't show any signs of it, We're going to say that, right? Let the market tell its story. I help it get the words out, but let the market tell its story. The data kind of speaks for itself. All right, Bill had another thought. So sluggish fall 21. Yep, and I think because so much activity was displaced or accelerated into the first half of the year, or into 2020. Also coincide with 79.7979% price change last fall. Oh yeah, that's true. Yeah, interesting. Okay, so the big bucks, you guys, cash deals as a percentage of sales. About 12.5% of our homes are bought in cash. Interesting, look at when we had all those first-time buyers. A lot of those folks are a little younger, right? Early 30s. So harder for them to come up with the savings, right, to pay cash. And so again, really fascinating to see that reflected in our data. Yes, down from when we saw a lot of investors and flippers, folks converting from owner occupied to rental. We saw a lot amount of cash flowing into the market at that time. Inflation adjustments, time check 247. Let's fly through a couple of these guys. Inflation adjustments. So red is just nominal home prices. This is the price that we report on, the price that you see, the price that we pay, plain old nominal home prices. That's red. In blue, we have implied home prices in constant $2,003, right? Blue shows inflation adjusted real dollars. And this is really interesting. So look at red, nominal home prices, right? Clearly well above their previous peak, right? Well above. However, once we strip out that effect of inflation, we actually see, okay, we're a little bit above bubble levels, but not that much, really not that much. And so, once we adjust for inflation, this kind of tells me, I'm not ready to say that we have a runaway market, right? I think one of the things is that, of course, oh, how I wish we could pay for today's homes in $2,003, but we can do no such thing. So, it's useful to kind of see, this gap is attributable to inflation, even though we haven't seen inflation pick up until, the last year or so. 2-3% a year compounded and compounded and compounded. You can see the impact. So pretty interesting. Yeah, let's skip this one, guys. Not that great. Remember the free air at the Shell or the Speedway gas stations? It's not free anymore. And do you know why? Because inflation. That's right. Because inflation. Okay. Always nice to see that the nominal index and the real inflation adjusted index sort of mimicking ours. We don't have that data back to 1990. We have some other data back to the 60s, but it is nice to kind of see that. How about closed sales over 1 million, guys? We're still talking about the big bucks. Closed sales over 1 million in August. Wow, 51%. Wow. How about September? Okay, about 5%, still rocking and rolling, still doing pretty well. How about October? Oh, down 12%. Is this random? Is this happenstance? Or are we going to start to see a pattern? So just like we did with price reductions, you guys, stick with me here. November, no, I didn't confirm that weakness in the luxury market. I did not confirm that weakness in million plus. Let's check December. Nope, we're back to growth in December. How about January? Nope, still back to growth in January. How about last month, February? No siree, Bob. We're back to growth in our luxury segment. So anomaly. October was an anomaly. I can't even remember back that far. I call it, we can call that dad brain, right? For a few more months, maybe. Was it cold? It could have been a little colder. I don't know. It's hard to say what was driving that, but we did not see trend confirmation of that. We looked for it, and we did not see a confirmation or a continuation of that trend. So I don't see any signs of weakness in luxury. I just don't. Also, remember, you guys, two other really important factors. One, buyers in this segment are not rate sensitive. Some are. Many are not rate sensitive. Also, a lot of buyers in this segment are not inflation sensitive, right? They're just not. Inflation disproportionately affects those at the bottom who, all their income goes to consumption. Most of the income goes to consumption, and when those consumable goods rise in price, it obviously impacts some folks differently than others. So Feb, overall, 21 compared to 20, 50%. We had a 50% increase in luxury activity over $1 million. Almost 1,500 versus 500, so almost 3 times the share, 3 times the number, I should say, that we had in 05. Guys, that plus 50% was already after plus 25%. So basically, million plus sales doubled in 2 years, right? From 750 to about 1,500, call it, just about doubling in 2 years. That's pretty crazy. I'm going to climb out on the skinny branches and say that's pretty crazy. Okay, affordability index. Here we see lower levels of affordability in the bubble, higher levels of affordability after the crash. Affordability, yeah, kind of been bumping around a little bit. Definitely down from peak level affordability. Down from peak level affordability, but still above sort of our lowest levels of affordability back in 05, 06. So I've included 2 scenarios. We're already going to blow through this one because we're past this on interest rates. So let's do 380 and 4 1/4. If our price hits 380,000 and rates are at 4 1/4, that would put our affordability index at 130, which is, I suppose, technically better than 06. But it's right between 06 and 07. It's pretty much bottom of the barrel affordability over the last 20 years. So something to be cognizant of. Affordability challenges. So comparing home prices and family incomes. MSP, median sales price, with MFI, median family income. So we've got 2 y-axes here, you guys, not to get too geeky on you, but prices in red, corresponding hopefully intuitively to these large numbers off to the left, and then median family income, still pretty large numbers, but a little bit lower in blue off to the right. Right. So what do we see when prices kind of do this in relation to incomes? Right. We had to have a market shift to kind of correct that. What's happening now? Prices are kind of doing that, relative to incomes. Maybe we're kind of at the beginning levels of it. Looks like this had a few years of that before we saw a market shift. So we could have a year and a half or 2, maybe even 3. I think that depends on what rates would do. My best guess, guys, and don't hold me to this, I think we got a year and a half of decent times before we really start to see these shifts. We are seeing some early indications of shift. We saw it with price reductions, right? So we are seeing some early signs, but remember, the market is big. It's a $16 billion market. It's like an oil tanker. Bad example. Warship, another bad example. It's like a really large boat that's going down the ocean. Let's call it the St. Lawrence Channel or the Straits of Hormuz. When you start to turn the wheel on one of these big boats, you think you're going to turn on a dime? No, right? So we start to turn the wheel and we don't see cruise ship. Thank you, Bill, a cruise ship. It's a Carnival or a Vikings, thank you, a Dutch River Cruise Lines, whatever. Yeah, and so you start to turn the wheel, you start to see activity now, but it's not really reflected until a little bit later. By the way, policy changes, right? It always kind of takes time to trickle into the masses. So anything the Fed is doing, if the Fed tightens incredibly quickly right now, they're not going to immediately get inflation under control, right? Because, well, the housing market here is a $16 or $17 billion market, but the economy nationally is a what, $22 trillion economy. And so these things just don't turn on a dime. We see slow movement. We tend to see slower movement. Minneapolis. All right. I know some of you guys out there work in the city. So just a couple words here. Urban market share. This is one that we really tried to update each month for you guys. Percentage of metro-wide Twin Cities sales that take place in either core city, right? So April of 2020, right? That month that immediately followed the arrival of COVID and the shutdowns. So we saw a little pullback in, urban activity, but what have we seen since? Can't make this up, you guys. What is this? So I think that was December. So December, I mean, we're really close here. We're within, we're within 0.1% or two. So this is actually the highest level since in almost 7 years, right? So urban market share is growing and it is back to 2015 levels. So it's well above 16, 17, 18, 19, and 20 levels. So, if you guys read about an urban exodus or people leaving cities, the data doesn't really support that. Sure, there's turnover. Sure, there's families that are growing. Sure, there's empty nesters. Sure, people are looking at another home office or home classroom. There's always going to be change, but that increase in seller activity was met with a corresponding increase in buyer activity. So we've seen growth in urban market share. I think that would surprise most folks. All right, at any rate, like that was a good transition. So 30-year fixed rates, you guys, 3.85%. That's a little dated. I followed the MND, the Mortgage News Daily, and I think they're showing 4.1, even 4.2. But again, our financing is a little different here than it is on the coasts. So just know that our mileage may vary, our results may vary. Guys, look at something else with me. When we see these sudden moves, there's fear in the marketplace, in bond markets, in stock markets too, over the last couple of weeks. There's fear in markets. What is $140 a barrel oil going to do to growth, right? And so we see this spike, and then we kind of trickle, right? And then we see this fear-based spike, and then we kind of trickle, spike, right? And then, so spike. I don't think we're ever, well, I should not say that. I think it's going to be a while before we see sub 3% mortgage rates, if ever, right? I think it's going to be a while. However, right, so we're kind of here now, 4.1-ish, 4.1. I guess I do kind of see us touching maybe 3.6, 7, 8, maybe again. Yeah, you see these kind of sudden moves. And again, it's because there's a lot of fear in the marketplace. Okay, oh God, we're coming up on time here. So I love this one, you guys. I absolutely love this one. It tells such a story. If a picture's worth 1,000 words, then a chart is worth 1,000,000. I've said that a few times. So median sales price, all normalized to 1990, right? Everything starts at 1. Median sales price, all-time highs. All-time highs. Mortgage interest rates, well, at this time, all-time lows, right? As of 2020, all-time lows. And I haven't yet seen an update. So forgive me, I know it's a little bit dated. So guys, prices at all-time highs, mortgage rates at all-time lows. What does that do to our monthly PITI costs, our monthly mortgage payments? They've actually been pretty flat. And, again, we have to run the numbers locally. This is nationally, meaning this is influenced by Baton Rouge, Jackson, Mississippi, not you, Jackson, West Virginia, rural Kansas, right? So, and also Manhattan and San Francisco, and Orange County and Miami Beach. And so, actually, I guess we're somewhere in the middle of West Virginia and Miami Beach, right? Maybe, I don't know. Okay, so, look at what has happened to these costs, you guys. Yes, they have risen, but they are actually not above their previous peak. At least not as of 2020, and at least not nationally. So what did we just see? Almost 90% of people in our metro have a monthly payment. Only 10 or 12% pay cash, meaning what? 10 or 12% are price sensitive, right? And by the way, those folks that, have the wherewithal to use cash for a sale, may not have that sensitivity, but if I'm spending cash on the home, I'm price sensitive. If I have my monthly payment, I'm really not that price sensitive. I'm payment sensitive. I just saw Todd Walker in the office. I think he said he'd be on the call today, but I lost my participant list. Todd has always said for years, for a decade, Todd has been saying, this is a monthly payment business. It's a monthly payment business. That's what people care about. Everybody reverse engineers their price based on payment. I don't want to pay more than $2,000 a month toward mortgage. How much house can I afford? You tell me how much house I can afford. I don't really care. I don't know. I just know I don't want to spend more than $2,000 a month. right? That's how your clients come to you. The majority of them, I would bet. Loans and forbearance. So we're almost at time, guys. Let me just fly through a couple more of these. Loans and forbearance, this is getting better. It is still slightly elevated, compared to kind of pre-COVID, but it is getting better. What are the real implications of an insufficient supply of housing, especially affordable? Nationwide, it's $1.5 trillion that it costs us in lost wages and productivity. So 10 years, that's 16 trillion. Decent amount of capital there. Unemployment rates, how are we doing? So Minneapolis, so pretty good, right? Pretty good. I'd like us to be above Milwaukee and Atlanta. I guess we're tied for 4th. So pretty good. Change in non-farm payroll employment by state. Guys, we're pretty strong, right? It's why they call us the North Star state, shining our beautiful light on others. I've shown this a couple times, but for any newcomers, over the last year, 33 grand in new equity for your typical homeowner, $33,000. I'll do it again. I'll climb out on the skinny branches and say, that's a decent chunk of a change for most of us and most people that we know. But that's only 10% price growth on 330,000, right? We saw that. We proved that. That's what happened. So when you really look at this, 33K, yeah, it's a lot, but it's only 10% price growth on a $330,000 house. I still don't understand for the life of me how those Hoosiers beat us, but they did. Okay, I'll end on I guess I got a mortgage rate. I'll almost end on a slightly comical note. The most Googled, should I question in your state? Should I care? Should I buy Bitcoin? Should I update to iOS 12? Should I text him? Should I care? Should I vote? Yes, you should, always. Californians, should I move out? Interesting. Guys, we're financially minded up here. Should I freeze my credit? People Google ridiculous things. What are we Googling? Whether we should freeze our credit to preserve our credit scores. Unbelievable. All right, mortgage rate projections, guys. We have exceeded these. So these are garbage. These are out the window. Kiplinger, so NAR 30-year, just kind of thinking about it. So we're pretty much there. I don't know that we end the year there, and I don't know if it's an average for the year. But yeah, Fannie and Freddie, I think, have undershot a little. And like I said, I said we touched 4.1. Maybe we trickled to 3.8, so maybe that average is actually pretty decent. Okay, last two, guys. Home loan amount. What happens as rates change? Most of you guys know this. Most of you have a sheet like this, or the lenders, or any financial institutions that you guys or your brokers have relationships with. I'm sure those guys update you, but just know when we go from 3% to 4% on let's call it a $360,000 loan, your payment does go from about $1,520 to $1,720. So that's $200 a month, right? That percentage point from 3 to 4 is $200 a month. It's $2.5 grand a year. That's not nothing, but if you're borrowing this, it's probably likely a 400, call it a $400,000 house. 10% price growth is 40 grand on that, you guys. So, yes, an extra 2,400 a year. I don't think anybody wants that. But when you really think about, how the market is and how strong it remains, maybe we can sort of temper that a little bit. All right, home price forecasts, NAR a little bit bearish here, average of everything about 5%. I think that's probably pretty good. How fascinating is this, you guys? From the Pulseonomics survey, they said 2021, they were expecting 11.74. And notice how, price growth is gonna, normalize a little bit moving forward. They said 11.74. What were we last year? Oh, 11.4. We were close, 0.3 off. So really not bad at all. Let's see. I'm going to end on a heavy note today. I don't know if everyone's aware, we're doing a lot of DEI work, our diversity, equity, and inclusion work. It's a really important part of our association, and professionally and personally, I think we all kind of believe in it and support it. So I don't know what year this is from, but I just wanted to offer this out for some reflection. And some insight into just how far we've come as an industry and just how much the industry has changed. So This article says a realtor should never be instrumental in introducing into a neighborhood a character of property or occupancy, members of any race or nationality, or any individuals whose presence will clearly be detrimental to property values in that neighborhood. To read language like that in this day and age, it's just kind of mind-blowing. But it is what that's what everybody knew back then. And so just to see this and kind of reflect on it, and hopefully, you know, as you guys are thinking about your own work, reaching out to, you know, other communities that may not look like yours, to grow your business, to help close our homeownership gap. You know, I want you guys to be thinking about this in our daily work. And I know that was a heavy note, but I will say, I'll stop in the name of love and open it up for any quick questions.
While we are waiting for questions to roll in, I will simply plug one final time that there are 10 spaces left for the open forum. That is Wednesday, March 23rd from 1 to 3 here in the MAR office, the Ed Anderson conference room. So if you are thinking, oh, that sounds interesting to me, go ahead and click that link in the chat. So that way you can be one of the final 10 people to sign up for that event. It's going to be the first of its kind here at MAR. We'd love to see some good turnout for it.
Yeah, it'll be really cool. An open forum, just share your ideas. You know, nothing's off limits. Well, within reason.
We'll keep it to real estate.
Yeah, I mean, let's keep it to real estate.
I don't see, oh, I do see one question from Kath Hammer saying, do you want to go ahead and answer that, David? I mean, oh, it looks like it's just a comment. My apologies.
Yeah, Kath has been one of the most incredible leaders this association has known. She had a transformational presidency. You know, we're so grateful to have Kath in leadership. She was instrumental with our building and grounds, you know, our outdoor remodel project and landscape project. Kath, your business is crushing it. I mean, she's so engaged at the association, and just a model for a lot of our members. So she calls me brilliant because I've got some charts, but she's the real superhero. So right back at you.
That's awesome. Well, I think that's a great way to end the update. Thank you, David, and thank you everybody for participating in you know, this virtual event. We'll see you sometime soon, hopefully.
Thanks, guys. Come back next time.